Excellent. Well, welcome everyone, and thank you so much for joining us today for Finalis' special webinar, 2025 Economic Outlook, the Impact of Trump's New Policies on the Private Capital Markets. I'm Federico Baradello, founder and CEO of Finalis, and it is my pleasure to host this discussion with some of the industry's top experts. At Finalis, our mission is to unlock the private capital markets by empowering investment bankers with a compliant, seamless platform to execute deals. And as part of that commitment to supporting our partners, we regularly host exclusive networking sessions and face-to-face events to provide insight into critical industry trends, opportunities in the market, and obviously for networking. And typically, these events are limited to our network of investment banking professionals, but given the importance of today's topic, we've decided to open this conversation to a broader audience. The private capital landscape is at a pivotal moment, and with a new presidential administration implementing significant policy shifts, there's a lot to unpack. And so to navigate these complexities, we've assembled an esteemed panel of experts. I'd first love to introduce Mark Sanor, founder and CEO of 361 firm, who brings decades of experience in law, finance, and private office investing, providing a unique perspective on global collaboration in the private capital markets. Stephen Burke, CEO of Ours Investment Partners. He's a veteran investor with deep expertise in alternative investments, private equity, and institutional asset management. And Bill Deuchler, a seasoned pension trustee and former CIO of major single family offices, who offers valuable insights into investment strategy, risk management, and capital allocation. So together, we're going to be exploring some key shifts over the course of this year that we can expect to see, assess the risks and opportunities presented by new policies, and also discuss strategies to remain resilient in a rapidly evolving regulatory environment. And so, we're going to be opening up questions in the latter half of the session. So please take advantage of that. We are really looking forward to a stimulating conversation over the next hour. And so with that, would love to get started. And I am delighted to hand things off to Mark, who, in addition to running 361 firm, is also a valued partner of the Finalis platform. Mark?
Thank you, Fed. Thank you, everyone. I'm a proud affiliate of Finalis. I really enjoy working with their team, and when you invited me to put this together, I'm lucky to have a great community at 361 firm. And so Stephen Burke at ARS and Bill Deuchler, who's been a CIO of other family offices and a trustee at a pension, they're two of our go-to people. Stephen speaks every week on Tuesdays, and Bill helps us compile our surveys, which are rather timely on these subjects, as you're going to see Bill present. So I'm glad that, I was just on another call with a bunch of affiliates of Finalis, and now here we are. So look forward to always working with you. Hopefully we'll all learn together over the next hour. I think over to you, Bill.
Sure. Mark, thanks so much. Really appreciate it. And it's been a pleasure. I think it has been 5 years now that I've been part of the 361 community. And I will dare say that it's one of the best communities I've found in the family office space. You pinged me on LinkedIn just 3 weeks before I started my CIO spot at the first family office. COVID was just closing in, and I was rather desperate to be able to connect with others. And it has been a wonderful thing. Many of the folks in the community have become very good friends, and so it's a real pleasure to be here with you and Stephen and with Fed and everybody else from Finalis. So very pleased to do that. I've got a couple of slides for background to help people understand sort of what happened during Trump's first term, and take a look at some of the economic situations that we encountered then. Perhaps past will be prologue, maybe so, maybe not, but we'll explore and see what things looked like back then. So we can go ahead with the slides. Great. So here we go. You can go to the next page, please, and we'll start off with one of the things that, as Mark mentioned, one of the things that we do regularly with the 361 community is to take a survey to find out how people are feeling about things right after the election. We wanted to see what people's opinions were with regard to Trump. Certainly a different president than what we've had relative to President Biden. And how did people feel about that? In general, we saw a pretty significant shift from things were a little bit pessimistic to much more optimistic post-election. And you can see the numbers here, both in terms of public markets and private market opinions, very strongly optimistic with Trump coming into office. With regard to the regulatory environment, even more so, 81% of the respondents had a very optimistic perspective in terms of what was going to be happening moving forward with Trump. And then with regard to the economy, also a very favorable response and indication that people were looking forward to what was ahead. The only thing that was a little bit less optimistic was with regard to the geopolitical situation, which turned out to be, even. Are you pessimistic or optimistic? Certainly, it's quite a flux out there. But let's go to the next slide, and we'll take a look at some numbers. A lot of people wondered, like, well, how did the markets perform during Trump's first term? Overall, clearly there was a lot of volatility, but overall, we had a cumulative rise of 69% over the 4-year period of time. Again, you can see the drop during the fourth quarter of 18. You can see the drop during COVID, but overall, a very strong rise in equity prices during the public markets. Let's go to the next slide. You can see year by year, during 3 of the Trump years, probably some of the best returns that we've seen in a long time. Not that dissimilar for the Biden 4 years, but nonetheless, some of the most highest returns that we've seen across decades were during Trump 1.0. Let's go to the next slide. During that period of time, a lot of talk about GDP and what we have going forward, but taking a look back, overall, it tended to hover around 2%. And I think that it's probably worthwhile stating now that a lot of the tariffs that Trump implemented were during 2017 and 18. Now, admittedly, the tariffs that we're talking about now are a little bit more widespread and comprehensive, but even still, you can see that the GDP was relatively strong even through those periods. Let's go ahead to the next slide. With regard to industrial production, this is the index levels, not the absolute values. But Trump started just with the index just a little bit under 100, peaked out just a little bit over 103, so a 3% rise, and then settled back a little bit. But overall, during his first term, industrial production increased between 2 and 3%. Next slide, please. With regard to unemployment, you'll see the COVID spike really sort of distorts this chart, but overall, it decreased from 4.8% down to 3.5%. That was, above, starting above where we are now at about 4.1, trending down to 3.5%. But overall, unemployment decreased during Trump's first term. Next slide. And inflation, it's something that we're all much more keenly aware of now because it's at higher levels. And we've seen a peak of 9% not so long ago, settling back down now into right around the 3% range. That's about, 50, to 100 basis points higher than where we were during Trump's first term. And you can see we did have some volatility in inflation, but overall hovering around the 2% range. Next slide. And finally, what I want to end with is taking a look at private equity fundraising, something that's all pretty near and dear to our hearts. During the Trump first term, we had steady increases in the amount of money that was raised for private equity, peaking out 782 billion overall. It peaked at 2021, and then of course we've all seen that private equity fundraising has been tough in this environment for the last couple of years. But again, going back to Trump's first term, we had a very nice season of consistently increasing private equity raises. Now I want to go ahead and hand over the mic to Stephen. He's got a couple of charts to go through, and then we'll move to Q&A.
Thanks, Bill. Well, clearly Trump 2.0 is highlighted by the uncertainty and the unusual approach to governing. And as you can see from this chart, the world is reacting to that. In anticipation of his election, you saw the uncertainty index move up. If you fast forwarded to the end of February or to current time, it would be higher than it was in the pandemic period in 2020. So certainly the world should have been ready for a lot of uncertainty around Trump, and yet we are still acting surprised by it. If you go to the next slide, please. What's important for people in our business, anyone, whether you're a banker or a client, to understand what lays ahead for us. You need to understand the 2020 Republican platform, which is now, this is what's listed on the White House website as the priorities for the administration. And it's these 20 items, which are part of the playbook that came out of the Heritage Project 2025. But one thing you need to know about President Trump, what he says on the campaign, he's going to try and do regardless of whether it's good policy or bad policy, which we'll know down the road. But he is going to go through this list and try and deliver on these things because that's what his campaign promises were. So very important to understand this because he's working on these things now. I think the limit on what he gets across will be really the Republican Party's, Congress's willingness to, or what level they're comfortable allowing the debt and deficits to rise to, which is the fight they're in right now. So that will be the limiting factor. So understand these items. He's working through the list now. You can see the way they're approaching it. He's doing this in an overload fashion where he's rolling these out in a very aggressive fashion. And what he learned from his first term was how to beat the system in terms of getting what you want done, in spite of the restrictions that Washington places on you. So important to have this as a background. We're going to open it up to the Q&A now so you can get to where you want to be asking your questions as well. So Fed, let me turn it back to you.
Thanks so much, Bill and Stephen, for teeing things up so beautifully for the discussion. And I'm thinking that maybe a good place to start would be to ask, I think, the question that everybody's asking themselves, which is, given this unconventional approach that the president is bringing to governing, what do you think the markets may not be fully accounting for, both in terms of opportunities and risks?
I think first thing is deregulation and what that means for the system. And to put it in perspective, I believe in the Biden administration, regulations were new regulations put in during his terms were equivalent to 3% of GDP. Eliminating a lot of those will be a boom for a number of areas, particularly the mid-sized companies who don't have the wherewithal that Apple would have to deal with regulatory changes and the lobbyists and all that. The impact on them of the increased regulatory burdens and administrative needs are quite high. They're actually higher on mid-sized companies than are on smaller companies who get to skirt a lot of those issues. So I think this is a big opportunity for mid-cap companies to start to take advantage of the deregulation that's going on. I think where the three sectors we're going to see most benefit will be banks, energy, and tech. And also for all of you on the call, M&A will pick up because of this. I think it'll pick up from the positives and the negatives that are going on in the system. So it's not just deregulation, but I think as companies are now coming to grips with the fact that rates will be higher for longer and you're not going to get multiple expansions, you're going to have to do it on earnings. And when you get into looking at how you're going to grow your earnings, you're going to start shedding some of the low return businesses, which will create some M&A opportunities there. I also think this is going to force companies to really focus on what lane they want to be in and put their resources to supporting that area. Because if you're having higher costs coming through from tariffs, if you're having big shifts in changing terms of trade going on, you're going to have to adapt your P&L to that. And I think that'll lead to more M&A activity. I think the other positive is that we are going to be promoting a better, more balanced energy policy between fossil fuels and renewables instead of an ideologic policy. And I think that will strengthen the US's position globally and create more opportunity. And you're seeing that with M&A in that area as well. I think those are a couple of the big ones. I think the other big one that people are missing, which is a positive, is twofold, and it's around government spending. I think the shift, we've had unusual government spending for the last 4 years or more than that, because of the pandemic, because of the war. We were actually putting with the pandemic, we put over 25% of GDP in fiscal stimulus. We have not cut any of the cost out of the budget. We've just added to it. And I think what you're going to see is a shift with DOGE from the federal government to the private sector in terms of the spending pickup. And I think you'll also see it push down to state and local governments. I think that's not being fully recognized. People think the federal government stops spending and nobody picks it up. I think corporations are going to be in a big spending mode right now. I think the second thing is around DOGE. And I think it's not the total amount that DOGE gets out, but if they can start to put trust back into the way governments have spent by digitizing a lot of the expenses and where the money is flowing out, you increase trust in the government. People will be more comfortable with the decisions that are being made and even more comfortable potentially seeing slightly higher taxes, which I think ultimately will be necessary because of our debt and deficits, because I don't think we'll be able to grow our way out of it. So I'll stop there. And Bill, I think you had some thoughts on this as well.
Yeah, no, Stephen, absolutely. I want to underscore the whole fiscal stimulus side of things, and certainly, that came from the government. And during the Biden administration, essentially the plan that they laid out at the very beginning, you could follow the money as their administration played out, and those were the areas that you wanted to focus on. With Trump, two things. Fed, I think you're gracious to say that it's uncertain. It's been a wild ride for the first 30 days. And I think that the unconventional way that Trump is approaching things is absolutely by design. And I think the shock and awe is intended to break things up, which is one of his promises. But differently from Biden, and I think differently from past administrations, is that he's going to focus not on programs, but regulatory relief. So being able to follow the trends of where is he focusing on regulatory relief, which industries are seeming to take advantage of that, that's the thing that you want to pay attention to. Also, as opposed to government-driven fiscal stimulus, watch for flows from the market. How are things transitioning there? Particularly, you can begin looking at CapEx. There's a lot of money standing on the sidelines, and how companies, once they feel sort of relieved from the regulatory clamp, once that gets released, how are they going to be spending their money? That's going to be a good indication. And then finally, going back to one of the points that Stephen made, and probably need to emphasize even more, is that Trump is a promises made, promises kept guy. What he says is what he has said he's going to do. And you can really count on that. So I think that as opposed to a lot of the uncertainty that's being generated by the shock and awe, the thing that you can rely back on is that here's the roadmap. Stephen had that in his last slide. That's the roadmap that he's going to be following, and you can bank on that.
I think there are two negatives too that I would add, Fed, that I think are not fully appreciated. One is the layoffs that the government's going to go through in the downsizing or the right sizing of government will have an outsized impact on certain regions, particularly the DC area, and it'll have big impact on the elections and real estate values. And think about government's cuts in the DC area and what that might do to real estate availability, commercial real estate needs, and things like that. I think you have to really be looking at when they start to go after parts of the government, what does that mean for businesses in that area and that area as a whole? I think that's one thing. The other thing I would say is lost in the government layoffs is about 13% of the federal government workers do not have high school degrees. And if they are laid off, the government benefits and the government wages are much higher than they could secure in the private sector. So they could see a downshift that is pretty considerable in their wages and wage opportunity. And I don't think that's being fully recognized by a lot, because they're getting paid significantly higher than people in the private sector for equivalent educational skills. So again, those who can least afford it will continue to be hurt the most by the policies of the administrations.
Yeah, I think that's a really good call out to think about, the second and third order effects of those mass layoffs. So let's maybe go a little bit more specific. I'd be curious to, understand from each of your perspectives, what specific policies of the new administration do you see as most likely to accelerate private capital deal flow this year? And in contrast, which ones do you think pose the biggest risk to the private markets?
I would start with the one and the same. I think tariffs provide the biggest opportunity, because the goal of tariffs are threefold, and I think this is something that is not fully appreciated as well. The first is obviously to bring manufacturing back to the US, which was one of his promises. The second is to rebalance trade, but the third is to generate tax revenues, because to extend his tax cuts, just extending them would require $4 trillion of funding to be found. To get to the cuts that he would like to do, which would be much more difficult, would require at least another $1.5 trillion to do. So I think he's going to have his hands full. So I think the idea of he's going to play games with tariffs, and if everyone gives us what they want, he won't put them through. I think we have to be careful with that, because I think that's missing the revenue generating need that comes with that. So I don't think that's fully appreciated either. But I also think the tariffs are doing what they're designed to do. And you saw that with the deals that countries are creating with us, which is to drive manufacturing and drive trade back to the US and to reshore manufacturing back here. So you have to believe that the areas, particularly around the industrial base, that's for military and industrial complex, is going to continue to be supported, because the four areas that we have to invest in every country are national security, digitalization, electrification, and this reindustrialization of the world economy that's going on right now. So I think that people have to really be clear on that being one of the those four areas are going to continue to drive capital. That's where the money's going to flow, and you have to appreciate those areas more so than I think virtually any other area.
Right. Yeah. Also, if you want to go back to the Republican playbook, points 3 and 4 really focused on energy, and I think that that's going to continue to be an issue that is going to demand a lot of attention. The drill baby drill is still being said out there. Point 5 spoke to manufacturing, and that's huge. Trump wants to generate more U.S. based jobs. He's going to do everything he can to bring back manufacturing to the U.S. If you look at points 8 and 12, we're talking about national defense. And, despite the mandate, to look for 8% cuts, there are some sequesters that are there, but I think overall national defense is going to be really important. And then on point 11, cities and infrastructure. So it's going to be approached in a much different way than the Biden administration approached it. But I think that those are still areas that are of great need. And I think that Trump is not going to let those go by either. So you've got some generalizations and you've got some specifics right there.
And just on the drill baby drill, our firm was subcontractors to President Carter's administration on the National Energy Plan. So we have a pretty extensive background in energy investing, and we're overweight energy by a good amount in our portfolios today. What I would say is that as much as he wants drill baby drill, I think the energy companies have a different version of what they need to do today, because of what happened since the financial crisis, when they were vilified, and with the ESG movement, where they were put in the penalty box for loans. Now they've switched from drilling for growth to drilling for profitability. So I don't think his demands of drilling for just to get more oil is going to work. And I think people have to be careful thinking that his desires are going to be met by the private sector in this area.
Yeah. Sometimes the slogans don't quite match up with the actual policy specifics.
Well, also, if the capital markets aren't supportive of it, what are they going to get paid for? Are they going to pay for drilling more, or are they going to get paid for earnings? And we're in an earnings market.
Bill, did you want to add something?
Yeah, no, I was just going to say certainly, big transition to much more fiscal responsibility on the part of energy companies, and so they've done well to do that, and so the potential for their profitability, and again, sort of as the regulatory burden gets released, they'll be able to continue to improve, but in a much more meaningful way, as opposed to just doing it by volume.
I want to maybe return to a point that Stephen alluded to earlier, which is maybe one of the areas that is generating some uncertainty, certainly among our foreign trading partners, which is around the question of tariffs. And so I'd be curious to just dive a little bit deeper on that. Maybe it's good to just level set on what are the administration's goals today as it relates to tariffs and renegotiating trade deals with foreign trading partners. And what do you believe are the potential economic and geopolitical consequences of that?
Yeah, I'll start, Bill, and
Yeah.
feel free to jump in. I think the first thing is it goes back to what I just said. He has three goals with tariffs: manufacturing jobs in the U.S. to appeal to his voter base. The second is to rebalance trade. He feels we've been taken advantage of by our closest allies, in particular Europe. And so I think those are the first two goals that he has. The third one is he needs revenues, and he needs the tax revenues, and and he's been convinced that this is the way to do it. Most economists think the math is fundamentally flawed and will never work to make up what he needs to make up. So I think this is one of those cases where being right or wrong doesn't matter. He's confident and we'll be pursuing that policy regardless. I think what he's doing is risking one of the biggest issues that exists in the world today is the bifurcation and the fight between the U.S. and China for global leadership, and China wants to upend it. And what we're doing with some of those policies of going after our allies is making our allies our adversaries, and our adversaries our allies is very confusing to all. And I think that's going to create problems for investors for some time. I don't think he's running away from the allies. I think he was trying to shake them up. And he's done that. And you're seeing that with their reactions. Europe has been riding the US coattails in terms of national security for 40, 60 years. They spend a third of what we spend on defense. He's looking at that saying, that's just crazy. Their GDP is bigger than ours combined, but they're only spending a third, and we're defending them, and we're having financial problems too. I think that where he's going to run into real geopolitical problems is we're doing this at a time that these other governments have huge demands on their financial budgets and very limited fiscal space. And Europe is a mess right now, and that's not helping us. It's helping our adversaries. So I think there's a policy confusion that he's putting through that isn't helping us, and it's helping our adversaries. And that's hard for people to get their mind around. I think longer term, this will pass. I think he's shaking up the world order to try and get change happening, and it's happening. But I think he's confusing people in the process, and it's not helpful.
Yeah.
Bill?
I think, kind of holding everything that Stephen just said in tension, you can think about the tariffs as being either an economic initiative or a national interest initiative. And certainly on the geopolitical side, he's lobbing these things out there to get people's attention. You think about the first few days of his administration, he announced the tariffs on both Canada and Mexico. What happened? Trudeau was like down at Mar-a-Lago, like right off the bat. The Mexican president was on the phone immediately. That getting the attention of the people who he needs to talk to, using tariffs as a vehicle for that has been pretty effective so far. So despite, again, all the shock and awe, it's something that is out of the ordinary. It's different, but it's getting the kind of results that Trump is wanting, which is to be able to get people to the table. So I think with all the objectives, that Stephen outlined, you have to think about it as well, that this is yet another chapter in the art of the deal. How do you get the people to the table? That's really important.
He also does have true believers, though, Bill. We have to be careful about who believe that the U.S. needs to be isolated and needs to go that route. I don't think that's a good policy, but I think it'll be an emphasis in the short term.
Right. Yeah. You look at Navarro particularly, was on his staff during the first term. Now again, very much so, and probably even more affectionately referred to by Trump as my Peter. We need to understand because clearly Trump is going to be setting the tone, but it's the next layers down that are going to be implementing it. So I think being able to watch what's going on at that level will also be, very important to watch for, canaries in the coal mine as far as indications.
The other thing you have to keep in mind is Trump may be the most market-oriented president in history. And the markets are telling him two messages. The bond market is telling you one message, that there's concerns about growth, and the stock market's telling you there's not. And he has to be careful which one he's taking the signal from at which time for his policies. So just something to keep in mind there as well.
Since the question is tariff related from our audience, I'll go ahead and ask it now. And the question is from Lloyd. Can somebody explain more about how the Trump administration plans to use tariff revenues to address fiscal challenges?
I'm not sure they can, to be honest with you.
Well,
You alluded to that, Stephen.
Yeah, I'm serious. It's math. That's all they're trying to play a math game. That's what they do in DC, right? How do you get the number that they're going to get his policies through is the game.
Yep.
So I'd like to say there's something real and meaningful behind that, but it's DC math is the way I would describe it.
Yeah.
And Mark, you were in DC with Senator Dole. So how do you see it?
I'll weigh in on other things, Stephen. I learned from Senator Dole.
I think there are kind of two parts to it as well. I think there's the immediate revenue that could be tied to the tariffs explicitly, but then also you think about, what's the end game as far as bringing tariffs up? It's to bring more manufacturing, to bring more commerce to the U.S. So there's going to be knock-on effects as those goals are realized as well. Obviously, that's going to be a longer term process, but I think that between the two, there's the hope of being able to bring back more revenue, to the government to help cover some of the spending. But as Stephen says, it's going to be a tough lift for that.
On the topic of revenue, I'd also be curious to get your perspectives on how you see anticipated changes in corporate tax rates and potential capital gains adjustments. How will those changes influence things like deal pricing, especially in the middle market?
I think the issue that people have to really appreciate is it's $4 trillion. He's got a $4 trillion hole to fill to extend the tax cuts. Just extending the current tax cuts, because what happened when back in his first term, we were at 35% corporate tax rates. The OECD average was 35, and he took it to 21. So we went too far. If we actually had that 4% difference, if we just went to the OECD average, we would have 4% more tax revenues a year off of just about a $3 trillion corporate tax base. So it would have helped plug some of the holes. So he's already gone too far. I don't think he can get to his 17% without blowing out the deficit. And I think this is where Congress is the Republicans in Congress are going to have to decide how big a deficit is acceptable to them, and what could they pass without Democratic support. And I think you have to remember we're less than 2 years away from the midterms. So there are people and the Republicans have a lot of seats that are up for grabs in the midterm. So there is that balance that they have to fight through. So I don't expect further cuts. I think what he can do is maybe do tips for gig workers, maybe adjust the SALT tax. He already threw out, reversing carried interest. So I think that one is on the table. After the first tax cuts from Trump, I actually saw Gary Cohn after he left the administration. And I asked why wasn't carried interest on the table. He said, we got it with the other deductions. It wasn't that they didn't think it was an area they could go after. So they'll go after it this time. And I don't know what they'll put it to, but I think that will have an impact. I think that is an area that for Trump's base, it won't be a problem for him to put that one through. So I don't think you're going to see
Well,
much. I think you'll see those areas and maybe the SALT tax raised to maybe 20,000 instead of 10. But beyond that, I wouldn't hope for much relief for any of your customers.
You know, if you were to have pulled most Fortune 500 CEOs in Q4, they would have expected a very meaningful pickup in the M&A markets. And a lot of that was tied to an expected continuation of the soft landing as it relates to interest rates, with the expected stabilization of inflation. I think it's fair to say that the early months of this year haven't really played out as folks might have anticipated just a few months ago. And so I'd be curious to get your perspectives on what you see playing out in the M&A markets. And you know, I'm sure there's going to be some meaningful reactions from the audience on that question as well.
I'll start and say the market has been wrong on rate cuts for about a long time. Put it that way. They got it wrong on the first time there were cuts. They were expecting a lot of cuts last year, at the beginning of last year, that didn't materialize. When they got the big cut, rates went up. And now they were still expecting 4 cuts in December, and that doesn't look like it's coming through. So I think the idea that rates are going to go down a lot from here is not good thinking. And if you're counting on a lot lower rates to do deals, then I would fish in another pond. If you need low rates to get a deal done, you're in the wrong sector. I think you got to go. We're in an earnings market, not a P multiple market anymore. You're going to see higher rates for a longer period of time, and I think you're going to have to really count on where companies are redefining, reengineering their businesses to right size their potential valuations. They're going to shed the low multiple divisions or departments or leave business lines to financial engineer their way out of it. And that will set up for M&A activity as they hive off parts of those businesses. So I think it's a mixed picture, not a zero interest rate one. And I think we have to get that mind out of our heads. We're in the old normal interest rate environment, not the last 15 years. And I think that's going to be a clearing out of a lot of people in our business, both investment managers, firms, and bankers. We're in the hard lift time again.
maybe Fed, I could speak to one theme, since we just did a tech summit yesterday. What scares and excites is artificial intelligence, the productivity gains, what we can do in healthcare and health tech, what we can do in so many industries. We heard it from panel after panel. And I think for this audience, raising money for private equity funds, venture funds, although I have to say private credit funds still is a very strong force, or hedge funds. We had the former president of Morgan Stanley answering what scares and excites her. And, and then in this geopolitical world we're in, because it's a fight, on the AI fronts and dual use and defense themes. So that certainly, we're talking politics, but technology is an interesting force for us in the capital raising markets.
Yeah, there were a lot of interesting themes that did come up in the survey. We canvass the community periodically, usually a couple of times a year, and a lot of different aspects. Robotics came up. Again, various aspects of AI were also prominently featured in terms of the response as far as what investors were going to be looking at. So there's no lack of fertile ground that's out there in terms of innovation and opportunities for companies to get going.
We received a question from a valued partner of the platform, Anthony Manara, who runs a cross-border Europe-focused investment bank called First Europe. Curious to get your thoughts, Stephen, Bill. The question is, given the demands for increased spending on defense during a very difficult time, as Stephen mentioned, will private equity firms open up more European companies seeking U.S. capital to abate the crowding out of European private investment capital?
That's a great question. I would just say two things on that. One is I think there's a huge opportunity in Europe for repurposing some of their old economy manufacturing into really ramping up their defense. And this is a big opportunity for them because they will have to, the numbers for them growing from their current spend levels up, they could easily do 300 billion, double their defense spending, and still be at only 3.7% of GDP. So they have a lot of catching up to do. So I do think that's a big area where manufacturing jobs leaving the auto sector, repurposing some of the auto plants and others into more defense-oriented, drone-oriented type of defense spends are something that they will be doing over there. The problem with Europe is you have to go country by country for that. You don't have any kind of European defense national champions or continent champions, but I do think that's an opportunity. And I think the US private equity will go there because they see it as a new fertile ground, and then they could start them over there, list them over there as public companies, and then bring them over here for a higher multiple later on. So there's a path to do that and bring it back this way too.
I think they're going to skip the European markets, only come to the US markets. I think Europe's in a real bind right now.
But that is one area, Mark, that capital is going to flow over there because it has to right now. And
it has to. Well, their
their
budgets are moving that way. Yeah, it has to.
Yep.
Yeah. No, I think also with regard to reshoring opportunities, for those companies in Europe that see opportunities, to either establish manufacturing here in the US or to be able to do technology transfer, those are two really good ones. So it's not like the rest of the world is certainly going to be left out. But I think given the realignment that you see, there are different ways to play that.
Yeah, I would just add too, on the defense side, the future of war is going to be very different than the past. So starting a defense industry now in Europe can be very focused on new technologies and the new way battles are going to be done. And that won't be with building a lot of ships necessarily. It'll be using drones of all different kinds. So I think there's a way for them to kind of leapfrog with the new technologies and new material needs that are going to be required for the future war. So there is a big opportunity in innovation like everything else, progress like everything else.
We have another great question from another partner of the Finalis platform, George Harrington, who runs Creed Venture Partners. And his question is, does the panel have any thoughts on what's happening in the nonprofit sector? The urgency is high to fill a vacuum of funding that's been created by the cancellation of funding of many programs. Private credit has been a very attractive asset category for private equity. Can the private credit market potentially fill the vacuum in the nonprofit sector?
So that's a really interesting question. I've spent a fair amount of time on the private credit side, and I think that given how things have changed in the capital markets, and particularly bank regulation, private credit is something that is going to be a permanent change, to the capital markets. The latest numbers are that it provided I think like $1.5 trillion is AUM for private credit managers. That's up tremendously from low, hundreds of millions not that many years ago. And I think that you can see sort of a differentiation between sort of more niche private credit as opposed to, the very large firms. Larger firms tend to look for private equity-backed companies, whereas the more niche ones are looking for those companies that are well established, but for whatever reason have trouble, not because they're necessarily distressed, but because they just don't fit the typical check boxes for regular banking. But I think that private credit has been stepping in to be able to fill those gaps, and certainly where there's a need. Albeit at higher interest rates, but nonetheless, capital is very much available there.
And Mark, we can connect the person who asked the question with Blue and to get, and some of your contacts that are in that space to get the inside perspective as
Yeah.
well.
We were talking about how technologies can help those community building to help the nonprofits address their needs and goes down the communities.
Yeah, well, we can take that as a follow-up point because I think George was excited to connect with others that might also be interested in digging in on that topic. We have another question from a partner. This is from Vitaly Galom, who's the managing partner of Mavka Capital, based out here in the San Francisco Bay Area, and it's a recession watch question. Is any of the panel expecting a recession in Q3 or Q4?
Well, Bill, that's one of our survey questions.
Yeah, absolutely. It's been fascinating to watch sort of recession expectations. They went from rather dour to somewhat mixed to uniformly like no recession anywhere. And I think that thus far the both certainly the U.S. economy as well as the world economies have shown themselves to be remarkably resilient. And I think that that resilience continues, especially here in the U.S. Oops, sorry, I've got my office partners, but yeah, it's been quite good as far as the U.S. being able to maintain continued economic expansion, particularly in light of inverted yield curves, which we've had for quite a while.
Yeah, I would just say that we're not in the camp of recession in the US. We have not been. We think the US economy is particularly strong. We think that the current interest rate environment and inflation environment are ones that we can continue to grow the economy with. I would be more concerned about Europe. I think the economic engine of Europe is sputtering at best. I think they're seeing a carve out of their primary industries over the last 20 years. While banks are making a short-term comeback over there, I'm not sure that that's sustainable, given that they didn't recapitalize the banks after their financial crisis the way we did over here. I also think the carve out of the auto industry and a lot of the primary drivers of the European economy are in secular decline. I think that's going to put them in a spot where Germany in particular is fluctuating right on the edge of a recession. I think other parts of Europe are going to struggle as well, but whether it tips over fully for Europe, I doubt it. But if they get the continued pressure up in rates and inflation, then they could get tipped over pretty easily. So I think that would be the one area. I think China can manage through their stuff, one by manipulating their economy, and two by their just size of their economy and what they are able to do growing it.
I think you'd agree, Stephen. It's going to come down to energy costs, where U.S. has the advantage, and regulation, where although I did see the center right in Germany, it's very tough for them to turn on a dime on regulation. They don't have an Elon Musk.
And they don't have a good investment fund. They don't have a good crisis fund right now to deal with the fiscal side of the house over there. Having a monetary union without a fiscal union has been problematic and will continue to be problematic for them. And now that they're having so many problems with their populations, desires for more support from the government at their time they're trying to pull it back, I don't see how they meet all their spending needs and all the population demands. So I think you're going to see a lot of one-term politicians over there if they make their full term, unfortunately. So less positive about Europe, very positive on the U.S. I think we're going to continue to rip, actually.
And by the way, Fed, if you did this 2 years from now, or even whatever, 19 months from now, we'll see what the midterm elections, the polls aren't really in Trump's favor last month or so. So we'll see what happens.
We've touched on kind of industry segments that we think are going to stand to benefit from some of the administration's policies. I'd be curious to maybe just double tap on this, which is, where else do you see capital flowing over the next number of years as a consequence of what we expect to be coming down the pike from this administration?
Bill, you have the chart where the community thinks. I think the infrastructure around the U.S. and around the world has been woefully underinvested. McKinsey did a report a couple of years ago that said the shortfall globally was $77 trillion. And we have a $110 trillion economy. So for perspective, 3/4 of the global GDP is what we need to spend to get it to a state of good repair, not excellent infrastructure. So I think that's an area that we're going to constantly see money flowing to for some period of time. That is one that has to go. And inside that, the grids are woefully underinvested, and that's going to continue to move. So I think from a macro perspective, that's how I look at it. Bill can answer from what the private markets are really focused on. Bill?
Yeah, in fact, that was one of the questions that we asked our community not very long ago, in terms of what's going to be your focus going into 2025. You can see in rather bold relief private credit. Going back to the question on private credit, that's a big one. But in terms of other areas, it's really very diverse. You can see energy transition, infrastructure. You've got affordable housing, oil and gas, renewables. Quite a lot is out there as far as investor interest. So I think that the field is pretty wide open as far as good opportunities. And we'll just have to see, healthcare, again, even some of the distress which really haven't shown up as of late, but quite a lot. I think moving forward. There was a lot of interest in terms of data centers to be able to provide for the energy needs for AI. That's an important one. You can see that actually transitioning from crypto mining over to AI data centers, power things there. But again, you can see the wide range that the community responded here.
And Bill, a big topic of discussion yesterday was robotics and agentivity and agents replacing service people in a lot of areas, and employees' functions or partial functions, as well as a big theme for capital flowing.
Gentlemen, as you know, there's a number of investment banks and bankers in attendance on today's webinar. If you were to occupy the seat of running a boutique investment bank today, how would you think about ensuring that your business remained resilient in light of the changes that we're experiencing on the policy side?
Yeah, I'll start, Mark, and you can wrap up. I think you got to focus on the secular themes. If you're so caught up in what happens in the short term, you're going to be schizophrenic. It'll be like the many faces of Eve. You just won't know how to act and where you want to be, because Trump's whole thing is to disrupt the world right now. So the way we think you remain relevant is look past the short term and focus on where capital has to flow over the next 3 to 5 years. And that'll lead you to the areas that are talked about by every country: national security, innovation, digitalization, electrification, and reindustrializing to deal with the way changing terms of trade are continuing to evolve. So for me, it's moving away from what everyone's focused on right now and taking a little bit longer term view. And I call it the stop looking at your toes and look down the road. Because I think that's the only way to navigate all the volatility that you're going to have in the short term, unless it takes too long to get deals done and to get them set up to be worried about the short term. So I would go a little bit further out.
Yeah.
I hit 3 things. And I'll turn it to you, Bill. I'd say 3 things you need. One is a great community that Finalis you're building and we're building, right? You need to keep listening to that community. Second is we just did talk about technology, investing in it and using it. Everybody, including everybody on this call, has an opportunity and a challenge. We could be replaced. So the key is use these agents to enhance your banking activities. We're doing it. I know Finalis is doing it. So that's important. And join our community. You can listen to Stephen every Tuesday. And Bill. Over to you then, Bill.
Sure. Yeah, I would wrap it up by saying, take a look at the 20 points again. See, how does your business map according to those priorities. Because once again, that's the playbook that Trump is going to have. Despite all the bluster, you know these are the areas that he's going to be focused on. So to the degree that you can serve your clients and serve the markets well by tapping into that, I think that's a good place to build out really solid resiliency in the somewhat volatile times.
I would also just one last thought is I would not count on rates to be your friend. So I would look for deals that you don't have to worry about zero interest rates again, because if we get back to zero, we have problems that none of us would want to contemplate if we get back there another time. So I think you want to really look at understand the macro and understand what inflation and interest rates are going to do, because we're going to be at these interest rate levels, I think, for an extended period, if not somewhat biased upwards. I'm not worried about rates running away from us either way, but I think you better be comfortable at these levels for a while, because if you need zero interest rates, your business is going to be tough.
Gentlemen, we're at time, and so I just wanted to start off by thanking you, Mark, Stephen, and Bill for your insights today. I found this conversation to be incredibly refreshing. There's a lot of hyperventilation that's happening out there as it relates to this new administration's policies and its impact on the markets. But I found that this was a really interesting and balanced conversation. At Finalis, we're committed to equipping investment bankers, to the last question, with tools to thrive in this evolving landscape. And we are very excited to continue the partnership that we've kicked off with 361 Firm, as well as many of the partners that have joined our session today, to continue to create spaces in our community for important conversations. And so we look forward to continuing to create that opportunity in the days ahead. So with that, thanks everybody for attending, and looking forward to seeing you all back here in this virtual liminal space sometime very soon.
Thank you all.
Thanks so much.
Fed.
Appreciate it.
Thanks, everyone.
Bye-bye.